Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Monday, February 28th, 2022. Just a side note, I will be here this afternoon. I'm not leaving town today as I thought I might have to, so if there's anything big by the close, I'll do another update. And just want to do another quick video, mainly focus on the markets. And starting, just want to talk about a couple other levels and drill down to some of the shorter term time frames. In the last video, I kind of updated the big picture, talking about how this former first target level on not just QQQ, really all the indexes, that has to go with convictions. And at this point, of course, the recent lows, I'd be remiss not to put a line in here, but I've harped on that quite a bit, so it goes without saying that the more indexes it breaks, in other words, you're going to have the best probability of those much deeper targets I have being hit if all the major stock indexes could take those out. In other words, not just one. Maybe the small caps drop down and the S&P and QQQ, they hold up. So again, I don't want to rehash the longer term analysis. I wanted to go down to shorter term analysis and just really, also talk on fundamentals real quick. This market for really since the last financial crisis all the way back in 2008, has had an implied put. It wasn't, an explicit Fed put pretty much. At that point in time, obviously the Fed stepped in heavy, but even then, since then, it's been implied as well that the Fed will step in and save the day anytime there's a big correction in the market, financial crisis. We saw it in 2015, 16. We saw it in that fourth quarter drop in 2018. We certainly saw them, just when I thought they really didn't have a lot of arrows left in their quiver, they did. They hit the nuclear button back in 2020 when COVID hit. And at this point in time, I think the vast consensus is they have used up nearly all their arrows in the quiver. They took rates down to zero. Really, where else could they go? So we know what's going on now. Let's not talk about that. How inflation is just continues to surge, and this whole Russian incident doesn't help that. And so I'm going, and what I'm seeing, I'll glance the news. I get the headlines pushed to be my email, and I'll see things online. But I'm not a news hound. I figure the important stuff's going to trickle down to me, and I don't hardly ever turn on the financial media. But so maybe it's been dubbed this. But what I'm seeing, and I'm going to call it, is Cold War II. Kind of a play off World War II. This is, to me, this is the Cold War all over again. You have, I think of Nikita Khrushchev taking off his shoe and pounding it on the table, saying, "We will crush you," and making threats of, nuclear war. Think, i.e., Cuban Missile Crisis, and that's when the whole Cold War came about, and then it was finally over when, technically, or considered over when the Berlin Wall came down. But we're right back at it now. You have a crazy Russian leader, batshit crazy, and using a not so veiled threat of nuclear war, using their nuclear armament if need be. And now you have some pretty, even though it's the conflict's limited to Russia and Ukraine, you pretty much have all the other countries joining in, and some severe sanctions. This is RSX. The VanEck Russia ETF, and you can see it just since this thing started. And I'm going somewhere with this, with the U.S. markets down 68%, and what was a matter of a couple weeks, months there. That was back on peak back in the end of October 29th, and now it's testing its 2000 and all-time low. That ETF came out in '07, just in time for the great bear market. Great time in there, Van Eck, on that one. But anywho, that's, they went down because everything else did. And Russia, it's certainly not a third world economy, and but it is going to be more volatile than the U.S. markets. It dropped 81% back then. But the point is, it's back to where it was then. If you look at, the S&P 500, where we are compared to where we were in '09, let's measure that out. After the bear market ended, it's up 580%. Yet Russia, in one fell swoop. Again, I'll have to look at the other indexes. This is just a quick one, an ETF that I had on hand. I always follow, and it's back to those lows. Now, okay, where am I going with this? Here's the thing. We've already got a big storm brewing, and I've been talking about for months now the warnings. I use the analogy tornado and hurricane warning. or yeah, a warning versus a watch. A watch being the warning being more severe, more likely that something's going to happen, and those warnings are still intact. Now, where this may come in, and you're going to say, oh well, yeah, Randy, U.S. is, that's Russia's mess. That's not our mess. And it could be any time over the years when I've seen the big problems in the market, it often stems from a smaller problem that gets dismissed. And because the global financial markets are so integrated, whether it's Mexico devaluing their peso, or any third world country doing that, or something else, something breaks in the credit markets, money market funds, they tend to have ripple effects. So the $1 million question here is one thing of many to consider here, other than the fact Putin's like a wild animal in a corner right now, and who knows, God knows what he's going to do, because these sanctions, he's going to feel the pressure. That I can tell you. These are working, at least right now, and so what he does, and where the whole conflict goes, is yet to be seen. I don't know. That's not my wheelhouse. That's not my area of expertise. But what I can tell you is, you have to think back, because this happened relatively very, very fast. Rarely have you seen a major economic superpower, see their stock market drop so much so fast. And so where I'm going with this is, you have to wonder now, what does that mean to the rest of the world, mainly us here? I know I'm being a little egocentric country-wise, but even in, if you're listening to me in Canada, UK, elsewhere, how much what exposure do U.S. funds, pension plans, pension funds, other big institutional investments have in Russian equity and debt, and or anything else? So in other words, there can be a trickle down effect, and you won't know that. A lot of times things start blowing up, and only later becomes apparent who had exposure there. So does this go away? Does the powers that be, make things okay, and you see Russia, turn out to be the buy of the century here? Anything's possible. And all I'm going to say is the risk, the same crash warnings, or severe correction warnings that I issued a couple months ago, that we're still on a warning, not a watch. That's what I'm trying to say. And again, a watch is conditions may be getting there, be on the lookout for. But when they upgrade a hurricane watch to a warning or tornado warning, that means there's a pretty decent chance of an imminent hit there. So take shelter or make the necessary preparations. And that's all. I'm going to leave it at that. You guys do what you want to do. I know we recovered. Going back to my whole 40+ minute video before, same thing a couple weeks ago. We're holding T1. We had a little intra-week break. Onus was on the Bears. They could have took it down. That would have been, at that point, it seemed like the most likely scenario, but no, they reversed it. But it is still at this point in time, just like last week, it's still just a back test to that level. So what I'm going to do is just take a look at a few other charts. Let's jump down shorter term. I spent a lot of time in the last video going over the daily and hourly, so let's go down to the 60-minute chart and tell you what's going on there. Remember, the 60-minute chart is all where it started, where it all started. This is a very messy chart. I would clean up these lines, but they were former support and resistance levels. I know you're not seeing much here, but just to recap, sell signal 1, sell signal 2, multiple short entries up here on the back test, and then first, second, third, fourth target hit, at which point I started moving towards, as I've said, to the weekly charts to be my guide, because this was just, at that point in time, another correction. But even when it happened, I kept mentioning, hey, we're seeing developments on the weekly chart that this could morph into a much it's a longer term trend or swing trade, instead of a quick, the typical quick get your 8-10% and run on a correction, then get back long. That's where we're at. But here's, I've covered this quite a bit. Let's look at the other things here. Let's look at this 60-minute chart of QQQ right here. There it is. Okay, so we had the fibs a couple weeks ago. Those were mentioned as a very objective shorting op, price resistance in the 50% Fibonacci retracement, which again, at that point in time, things have changed, but at that point in time, it was a move down from the all-time high to that major reaction low. and we had a 50% retracement and a 61.8 on the S&P 500. Then fast forward, just a couple weeks ago, I mentioned your next objective and what may have been, I'm not going to call it the last objective shorting up, but you know me, the closer we get down, the more oversold the markets get, the closer we get to targets, the less objective it is. You know, these were the best shorting ops back here for trend traders. But if you're actively trading or recycling back in, I mentioned R1, R2, and boom, we stopped right there. It was almost exactly between. So that was more of a resistance zone. And now I also then said when we break this line here, that would trigger sell signal. It was a near-term uptrend line. I wasn't crazy about it, but it did. We broke it and it triggered some selling. And look, now we're back testing that. So this is why I wanted to do the video, show you short-term levels. And I've got some others that I'm really eager to show you here. But that's it on the 60-minute chart. But then this is that divergence, which I wish wasn't there. Only because, not that I wish ill on the markets and I want them to go down, but just that, you know, longer term, it's still, the bearish case is still intact. And as such, it's telling me to be short, but not right now, not aggressively short with divergent lows, but pretty much I got a pretty decent position, but room to add, but I'm not adding right now. You could, and again, what I'm doing is not what you are should be doing, because you may have completely different entry and exit points. I'm in and out, long, short, gain, counter trend rips, layer in, layer out, reduce exposure, you know, able to trade overnight with futures, things like that. And it's a whole different ballpark for a less active trader. But you have a rough trend line here, and I'm going to get to it on another board. And you also have a back test of that uptrend line. So there is resistance. Ideally, again, you don't always get what you want. I say that a lot. Ideally, but if the bearish case is going to stay intact, we should get rejected about here. Let me show you a couple other things here. So this is, I talk about Fibonacci clusters. So we already had a major reaction low there. That was when I gave you, that was the all-time high down to there, and we retraced 50% on the fib, 50% Fibonacci retracement, meaning 50% recovery of that previous drop, and at the same time that's where the S&P regained the 61.8, and it proved to be and pointed out as an objective shorting level, and sure enough it was still, and if you shorted that, then you're still very, you know, quite profitable. Let's say, it depends again how much you did and what you did. Now what I wanted to show you is I put up some other fibs. I talk about Fibonacci clusters. And so you can take, as you know, you can do a Fibonacci retracement on the all-time high. We can do that now. I'm just curious to see where we are. I was looking at more shorter term stuff. So we are at a little bit below the 38.2, and let me turn on the 23.6, above the 23.6. I'm going to take that off right now and just focus on these three previous reaction highs. Let me park the indicators so you can make full use of the real estate of the screen. And so I took away all the other fib lines, but what this purple line does, it is a fib line that comes in at this high right here. So that's what I hit. All three of these lines, I got a blue line here at this previous reaction high. So what I'm doing is the three most recent reaction highs, 1, 2, 3, right? The lines, you know, are level to that top. I just move them over to get them out of the way so you can see it. So 1, 2, 3, all down to the recent lows right here. I have purple, blue, and yellow. And I know it's hard to see. I probably should flip this screen over to white, but then I got to change all the settings. I can just tell you, or you can replicate this on your own. It's very easy to do. Put up those fibs. You have a Fibonacci cluster. They're all three coming in together here. You have the yellow and blue lines right here, and that is the 78.6% retracement of this move down from this high right here, the yellow line. Has now retraced to really to the highs today, 78.6. The 61.8 of this move here from here is right a hair above it, and then perfectly overlapping the 76.8 on this move down is this one here. That drop there, we've retraced 61.8 of that one as well. So remember, that other 61.8 is just above. So this is what fib traders refer to as a Fibonacci cluster. A cluster of Fibonacci retracements, again, off the three distinct reaction highs most recently. And again, it really doesn't guarantee anything. There's at times a bit of randomness. If you put up a bunch of fibs everywhere, you're going to get things. But again, the more levels that you get, the more likely it is that traders are watching and trading off those levels, and you can turn down. And I want to show you one other board. So this is a 60-minute chart right here, and I need to put back the PPO. Okay, so all right, so 60-minute time frame of QQQ. And you know me, I like to play around with indicators. A lot of traders just leave the defaults on. You look at the 0 line on the PPO, and if it's an RSI, they have the default 70 and 30 overbought, oversold. But I study these charts. I look for patterns and things like that. And what I've noticed, and I've shared this one, I believe, a while ago, but it's the first time updating it. It's right here. I went in today, and I had all these circles here. I had a line that it seems that 0.53 level right there. It's that horizontal line I added above the 0 line. Again, it's at 0.53 on the 60-minute PPO. Okay, I had to pause the video there for a couple minutes. That's somebody at the door. Back to where I was. All right, so that's it. 0.53. I believe I was talking about this, the level that seems to be, at least as of late in recent months, we're going back to September here, the stopping point for rallies in QQQ. We had again a tag of that level right there. All the circles show when that level was hit, and you can see what happened since then. So we'll see. History doesn't always repeat. Sometimes by the time I recognize a pattern like this, that's when it stops working. But right now we have that plus, you can see here, a potential downtrend line. It's not my favorite trend line, but it's decent. You had reaction there shortly off that high, real close right there. Brief overshoot there, nice perfect tag there, and right where we are. So look, where am I going with this? That's an ideal stopping point. It is an objective short entry. Again, it depends on your positioning and your thoughts on where the market's going. If I just came into the day today, I was flat over the weekend, and I felt pretty good that this rally is at or near an end. This is where I'd be shorting. But again, I already have enough short position. I'm going to watch to see what happens, but that's me. I did want to point out this level. And again, if we take it out, then there's going to be a change of character. Although look, we did pop above there briefly, but again, it's so either the tag of that level, which I pretty much circled, or the cross back down below. We don't stay there often. You don't see, you got up there this point in time, you stayed there for just under it for a while, and then when you finally popped it right there, that's where the top came in. So thought I'd share that. More of active trading stuff, and then to jump all the way down to the 5-minute chart. Remember on Friday I gave you, usually I don't post short-term stuff on the home page, once in a while in the comment section, but here's a 5-minute chart of QQQ. Let me move the histogram out of the way to give us a little more working space here. You have or I should say you had on Friday, this is it, you had a bearish rising wedge on the 5-minute chart, which is very conducive to short-term trading. And we got shortly before the close, we had a breakdown there, might be about midday, and we went sideways. And then we closed the day, there's the daily close right there. And then we picked it up today at the open, still in there. So it set up this trading range right here. And I even posted this morning in the comments section from, I guess it was Friday's post, that we need to take out the bottom of that for the next sell signal. And that I had in there at that point, you had a marginal incremental new high right there. And now we popped the top of the range, and that gave us all it did technically is extend the negative divergence that was already in place at this high. Now you have a bigger divergent high, and two things happened. So not only that, you extended the negative divergence. Again, we're talking 5-minute chart, but then you fell back into the trading range, down to the bottom, you broke it, and you're back testing it from below. So if you are an active trader, you can say, well, I can short QQQ here for a swing down to the next target or any of these potential targets, or maybe that's it. Maybe one of these seemingly minor breakdowns on a 5-minute chart, sell signals morph into the next, the top of the counter trend rally. Again, when you look at the weekly chart, that's short-term stuff. this is what, if you're not an active trader, this is what you want to watch. You want to watch this, you want to watch a daily chart, you want to watch all the key sectors I went over last week. I went over XLK. A lot of these either coming to and bouncing off support, or in the case of XLK, very nice support at 146.86. Broke it intraday again. There was something that happened that morning, a huge surge in buying, whether it was natural buyers or PPT or any variation of the government supporting the stock futures, because that's really when the Russian invasion happened, that overnight. And then we came in, instead of plunging or following through what the futures did, the minute the market opened, they started buying it up. And again, it doesn't matter whether Joe Schmo or the PPT or anybody was buying. There were buyers. And at any point in time, it's very, very simple. In its simplest form, the stock market or any stock out there, any security works. You have two components. You have buyers and sellers. And when you have more buying than sellers on any security, the price is going to go up. And when you have more sellers than buyers, the price is going to go down. And that just tells us on that given day and the following day, there were more buyers in the market. And buyers could be short sellers that are covering their position. So undoubtedly, a lot of those shorts covered that day. You saw the big reversal. So the big question is, where do we go from here? And I've already addressed that. Lots of resistance levels overhead, but also positive divergence. So it's really, I've said it quite a bit recently. To be comfortable in the down scenario, you want to see these divergences taken out. And they can be, and I've seen them taken out. And I gave you that example today back in 2018 when we had beautiful divergences on the index. And it was only a counter trend bounce with more downside to come. The other sectors that I highlighted, all the S&P 500 big sectors, XLV, again, this was a beautiful support, 124.76. Why beautiful? Well, you had a trading range right there. You broke above it. You successfully back tested on numerous occasions there, all successful, rallied, came in, back tested it again, and back tested again. And I've made this analogy. It looks like so many stocks and charts, or even the sectors like the IWM that topped. You had about a year-long consolidation sideways trading range, followed by a breakout to all-time highs, which then failed. You came in, you fail, you go bottom, you test the bottom of the range at least once. You usually get one last bounce. Again, this is just XLV, one of the 11 sectors of the S&P 500, but it reminds me, does look just like IWM with that same year-long topping range, same breakout to new highs, but occurred with negative divergence, sent it down to the bottom of the range, had two bounces there. The buyers, like Pavlov's dogs, they've been conditioned, step in and buy the bottom of that range, and I get it, and it works. And like I say, it's my version of a yogiism. It works until it doesn't work, and when it doesn't work, get out of Dodge. And so when it stopped working, boom, the bottom fell out of IWM. And then that becomes resistance. So that's what I'm looking for. The takeaway is those sectors that held support, whether they tested it like XLV perfectly and bounced last week, or those that undershot. And this is why I say watch. This is why I get so wordy and lengthy in these videos. It's not about, even if you're only trading the S&P 500 or only trading the Russell 2000 small caps via IWM or futures, you got to watch all the other indexes. And really, the whole stock market's like a living, breathing organism. And the point is, if IWM breaks down, the small caps break down, but yet at the same time, all the other large cap and mid cap indexes or hit and bounce off support. Well, guess what? That program buying, the flow of the markets, is going to bring IWM back up most likely and cause that breakout to fail. In the case of the S&P 500, it's simply a sum of its parts, and those parts are its 11 sectors and all the stocks within those sectors. Since we can't track 500 different companies, it gets too complex. All we do, or at least all I do, is track the 11 sectors and then quite often the top components there. So that's what we need to break. XLK, all of them are the recent lows. I said that last week because those recent lows coincide in many cases with big support levels like XLF. I've had that level yellow for a while, $37. I mean, look at how many times, especially most recently, we tested that. Had one little false breakout there, but recovered it. It was support. It was a trading range. When we were below it, it was resistance. When you were above it, it was support. And that's it. I really can't. again, at the risk of oversimplifying things, it just really doesn't get any easier than that. You just watch these recent lows, the fact that they've been tested again and again. I view support levels when the charts tell me otherwise. If I'm bullish, I'll look to buy and position on pullback to support. But when the charts tell me otherwise, I view that as knocking on a, let's say, an old floorboard or something you have. You're tapping on it with a hammer. You're tapping on a piece of wood, and the more you bang on it, ultimately it's going to break. And so that's what we've been doing, banging, banging, banging. But again, support is support until less broken. Sometimes a breakdown looks inevitable, looks most likely, and it doesn't happen. If it was a sure thing, guys, I'd say stop, put all your money short, and buy the out of the money puts you can buy to leverage your money up the most. Just put all your money in there and shut the computer off and walk away and cash in 3 months or 6 months. It's not that easy. But like I said, it will get easier to predict where things are going and how they're going to get there. If those recent lows are taken out, then we should go on down to my next targets. And if not, then we bounce, and then I'll start talking about overhead resistance levels that are likely to come into play. So that's it. Communication sector, consumer discretionary, industrials. This one's interesting because they did break the yellow line I had, which was key support. But again, a few sectors, those that didn't perfectly test and bounce off support then. In XL, I did have some support. There was a downtrend line there and price support there at about 93.80, but it took out a more important support, and it proved to be just an intraday break. Why? Well, I can all but guarantee you that if the rest of the market didn't bounce that day, XLI would not have recovered that level. And it recovered it, but so far it's been muted. We had that big reversal day, followed through on Friday, and so far no real follow through. But obviously I want to see it drop back below 97.80, and then again the recent lows. And last but not least, I have not forgotten about you futures traders. Keep an eye on them all the time. This is NQ. This is a 60-minute time frame. Again, the downtrend line isn't perfect, but it's roughly this, same as QQQ. You just have a little brief pop here you can allow to exclude. Sometimes trend lines work out perfect, but it's really, you just eyeball, and it's what are the majority, where are the majority of the reactions. So there's a downtrend line, and it forms. You had a big divergent low right here. I'm sorry. You did not have it on the PPO because we made a lower low there, but you did have it on the RSI, positive divergence, and a pretty good move up. So this is to me an important level, and just to kind of wrap up here, the common theme is I showed you some resistance on the shorter term charts, Fibonacci clusters, price resistance, and I'm showing you a downtrend line, which is resistance here. If that trend line gets taken out, there's plenty of price resistance overhead, as well as additional Fibonacci clusters or levels, even off the previous highs. And if you look in real tight here, and this could be our catalyst down, because again, I said it in the previous video, it would really help to see the markets turn around now and reverse and head down this week to keep those bear flags intact and open the door for a swift move down. But the sooner we reverse and the sooner we take out those lows, the better. As long as we get a nice fat red candle this week, the bearish case stays alive and strong, especially if the lows are taken out. Well, yeah, would or should. Then other than that, at least to see some consolidation here and not move up much above the levels that we're testing now, that we're back testing on the weekly chart. But there's a 60-minute wedge. What I'm looking at here, negative divergence on both the PPO right here and the RSI, divergence there in price, and it gives you a small bearish rising wedge. And the uptrend line's pretty clean too, guys. Look at that. Here's the recent lows right there. You can see us dancing on it. So if we can break this, the measured target of that wedge would take us down, pretty good. And again, it could be the catalyst for the move to run at those lows. So watch that 60-minute rising wedge on NQ. There's what ES looks like. I have to zoom in real tight here, but I could do that for you and show that we also have a small divergent high. I'm going to take these lines here. See, there's your same comparable uptrend line. Slightly higher high there and lower highs in the indicators. That is negative divergence on the 60-minute time frame. And so, boom, if we can pop those trend lines, solid, especially a solid 60-minute candlestick close below, that should be the catalyst for the next move down. At least we'll probably come in and back test that downtrend line on ES, the S&P 500 futures. So there's a potential target for you active traders. And I'll tell you the last thing, I'll wrap it up. I haven't looked at RTY on the short-term charts. That's just a 5-minute chart, and you can see it actively watching this as well. There's a uptrend line on the 5-minute chart of RTY, but let me jump over to 60-minute and see if there's anything that stands out to me. Yeah, you got see the downtrend lines aren't clear. I've got a couple. I've got this one there, and I guess that one's probably the one in play right now because you have one, two, well, three, several reactions there. Another one there, and now another one there. And we also have, just like I showed you on NQ and ES, nice negative divergence here. Boom. There's your higher high in price. There's your lower highs in the indicators. And there's a fairly well-defined uptrend line. I got to push a little bit here. Let me try that again. Let's come off the lows and say that's what it looks like. So there's your patterns, guys. And that's for both. Again, could be an investor looking to add to or get into shorts. Could be a long, someone that took some longs recently and really wants to run some tight stops. You might not want to let all those indexes break down. Active traders could try to game it for a quick pullback trade, and longer-term investors could sit tight, trail stops down, and see if those recent lows get taken out. All right, let's wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.